Property investors make so much money every single year, but barely pay any taxes. Here's why. But first, let's explain how taxes on properties work. You'll be surprised, but many people don't have a clue on how properties can make you more money every single year while reducing the amount of tax you pay every year. Interesting, right? Let's jump right into it. There are generally two reasons to buy an investment property in Australia. First, capital growth. The goal is for the price of the house to rise faster than money sitting in the bank. Normally, the bank will pay you interest income on the money you have, and that currently ranges from 3 to 6% in recent years, whereas property prices have had an annual growth of 7 to 15% in recent years. Now that's a big difference. And secondly, rental income. This is pretty self-explanatory. You can receive income when you rent out the property, less the property rental expenses. And if you end up with a rental profit after expenses, this is known as a positively geared property. If you end up with a rental loss after expenses, this is known as a negatively geared property. And conveniently, capital growth and rental income have their own types of taxes. So let's start with rental income and expenses. When you buy an investment property, even for the growth, you're probably going to rent it out. This rental income is income and taxed like so. So let's say you're earning $100,000 from the current job, then you rent out an investment property for $30,000 a year. The 2024 to 2025 tax rate would mean that 30% of the rental income is taxed. It sounds straightforward, but let's not forget that there are a lot of expenses with your property. The biggest one being the mortgage and the interest itself. Most of these expenses are actually tax deductible. These include interest on your loan, repairs and maintenance, council and water rates, insurances, property agent fees, and best of all the depreciation on equipment, fittings, buildings, and the structural improvements. So normally, depreciation expenses has been paid already when you purchased the property or did improvements before, but you still get to claim this significant deduction every single year. So if all of these expenses actually end up more than your rental income, something magical happens, and this is called negative gearing. In your tax return, the losses you make counts as a tax deduction, which then reduces your total taxable income. So let's go back to our previous example. Per year, you get $100,000 from your current job. $30,000 is rental income, and let's say all the expenses for the rental expenses cost about $50,000. Instead of being taxed at $100,000, you actually get taxed as if you're earning $80,000. And with a 30% tax rate, that's $6,000 right back in your pocket. Of course, ideally, you would have a positively geared property making a profit, but the fact that your losses can be offset puts a lot of pressure off a property that performs weaker with their rent. There are also expenses that can be claimed that are not out of pocket for the investor. Expenses like depreciation can push the rental property into a loss without affecting the cash flow for the year. Now, not to get political, but to me, this is the #1 reason why property investing is so popular amongst Australians. We can't blame people for wanting to take advantage of the tax ruling that exists. Don't hate the player, hate the game. Now onto the second tax, capital gains tax, otherwise known as CGT. It's relatively simple, but basically the most funnest tax I can find because you can find simple ways to minimize this tax. If you sell something, you either make a profit or a loss. Losses, again, can be offset against your taxes. Profits gets taxed. This is how you figure out the profit. Total sales price minus the cost base. Total sale price is how much you sold it for. Pretty self-explanatory. Let's go with $1.4 million for the property. Cost base is how much you bought the property for. In this example, let's go with $1 million. Therefore, profit on $1.4 million minus $1 million is $400,000. That $400,000 then gets hit with what you call capital gains tax. Assuming no other exemptions are applied, that $400,000 is then taxed as income, and that's a lot of money. Almost half of that gets taxed. And thankfully, for investors, there are heaps of different types of concessions for CGT. The first one is the 12-month rule. where if you hold a property as an investment property for over 12 months, you get a 50% discount. The capital gains gets halved to $200,000. So in this case, instead of paying $180,000 in taxes at 45%, you pay $90,000 instead. Now, life isn't quite that simple. So here are a few common scenarios that you can relate to your personal life. What if the property that you purchased, you lived in the entire time? Well, the good news, as long as it's registered as your principal place of residence and you live in it, then you don't pay any CGT at all. And what if the property was your principal place of residence half the time? A little bit more complex. Let's say you owned the property for 10 years, the first 5 years was your principal place of residence, and the second half was your investment property, and you rented it out. Most of the time, you calculate the cost base at this moment when you start renting it out, and figure out the profit from there. You do this by getting a property valuer, and generally, most effective time to do this is when you decide to rent it out. So let's say, for example, in the year 2000, you buy a property for $500,000, and in the year 2010, you decide to rent it out as an investment property. This is where you get it valued by a property valuer, and let's say they say it's $1.5 million. Then you sell it in 2020 for $2.5 million. So you'll pay CGT on $1 million instead of $2 million. Good thing is you can use the 50% discount to half the gain to $500,000 and you pay 45% tax on that $500K. There are a lot more concessions on top of that, but they generally get really complicated, so be sure to speak to an accountant before selling your property or speak to them once you've sold your property. And I'm not saying this just to make sure you save a few $1,000. This could save you tens or, if not, hundreds of thousands of dollars. I had a client come in telling me that they paid almost $500K in taxes, only for them to later realize they only needed to pay $100,000 because they lived in the property at one point of time. You don't know what you don't know, so it's best to speak to an accountant. And if you're a property developer, different rules apply. It's really complicated, so just consult a tax expert if that's the case. When you're a property developer, the main thing is that the purchase of the property is considered trading expenses, so you don't get access to capital gains tax discounts and all those tax concessions. The cost of the purchase and the construction cost is considered purchases and used to offset the business income. The business income will be the sale of the property and the income from that. Most business owners will have to deal with something called a GST margin. And as I mentioned, it gets quite complicated. But basically, if you're doing property development or knocking down a property to build a new property for sale, just do yourself a favor and speak to an accountant. All right, the biggest secret to how to minimize your taxes for property investors is just never sell your properties. If you don't sell your properties, you won't get hit with a hefty tax bill due to capital gains tax. And I'm sure you're thinking, well, how do I get the profits out of my properties for cash flow purposes? How do I spend my money? How do I live? That's where bank financing comes in. A lot of investors will receive a growth in their property prices, and then they will take out this money by refinancing their loans. Take the $500,000 property purchase example. The property was purchased in 2010 and increased to $2.5 million in 10 years. So instead of selling the property, the owner could go back to the bank, ask them to draw out equity from the property. The bank will lend up to 80% of the value of that $2.5 million market value of the property. That is $2 million in cash. Now you take that $2 million and rinse and repeat. You purchase more property, you invest, and then you refinance back out after the growth. Obviously, most property investors do this every couple of years rather than wait 10 years for that growth. And these are the basics of taxes for property. It may seem like it's simple and easy when you see your accountant, but they're not gonna know your life story. So you'll need to have these ready to make sure you get the cleanest and most effective tax return. Keep records of your purchase contract, your loan statements, your loan agreement, legal fees, borrowing expenses, bank fees, council rates, water rates, annual rental statements, and receipts of any expenses not covered by your rental agent. Track all these expenses in a spreadsheet and keep copies of all your invoices in one spot. I like to scan and keep digital records of these so it's actually easier to store, but don't forget everyone's situation is unique, so info in this video is not to be taken as advice. Like I said before, there's a good chance there are things you didn't factor in that your accountant can flag. Plus, you don't want to be trying to claim deductions you're not eligible for, because you can really mess that up. And now, to be honest, there are a lot of concessions when it comes to property taxes. I'm gonna get flack for this, but I think a lot of these need to be canned. It's the reason why Australian property prices are one of the highest in the whole wide world. I've talked about it in other videos and podcasts, but the median income for a single adult in Australia would take over 30 years to save up for a deposit for a median priced property in Sydney, Australia. That isn't right. And you can't blame investors either, since they're just trying to play the game. Most of them are trying to secure a better future for their family and make their money be as effective as possible. Like I said, don't hate the player, hate the game.